Joining us now is Paul Richards, Medley Global Advisors president. He's been saying that more attention needed to be paid to the movement in bonds. So explain that to us, Paul. It looks like yesterday you were right.
3 months ago I was here and we were talking about the flattening of the yield curve. The 10-year was 2.05%. And all the doomsayers were predicting 175. And here we are now at, what, 246, 247. Why that's a concern to me is that we're knocking on the door of 262, which was the high this year. And it's generally thought that if that breaks, where does it go? And that's 3%. Why I'm concerned is that the market is so long of credit, so long of EM, so long of equities. One of the reasons is I've had no alternative investment. What if the 10-year does go to 3%? What if we get a rogue inflation number, say CPI on January the 12th, I believe it is? Yeah. What if that kind of number upsets us? And the reason I mentioned it yesterday is that I've met with a number of pretty major investors in the last week. That is their #1 concern from a risk perspective going into 2018, and it strikes me that nobody's talking about it.
Well, I think part of the reason why, and just to push back a little bit, is because every time we get a little bit of a hiccup, and really what we saw overnight really is a little bit of a hiccup in the scheme of things, people call for the end of the world and for the bond market to unravel, and it hasn't happened, and it hasn't happened. And this time, why should it be different? If you have pension plans that still have to buy debt, you've got worldwide investors looking for yield, we have it.
I tell you one thing I think they're also missing. I think it's a very good point, but one thing I would add to that equation, central banks are buying less. And they will continue to buy less. And I think that's not on the equation. And as we've always tried to price QE, I mean, QE's been this thing we've been living with for 10 years. We still don't really get it, but we're certainly conscious of the fact that it's had a very positive effect. In the unwind, we don't know what that effect has in terms of the yield curve, in terms of the dollar, and markets in general. So I think that's the unknown that we still need to better plug into. And frankly, we don't know the answer to that yet.